In this week's update, the biggest moves of last week, the best way to deal with this market, and where to for commodities. My name's Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Another topsy-turvy week. I thought it was still very relevant to review a couple of slides that I showed last week just to prove a point that is really valid. So this was one of the slides from last week. Market lows occur when the news is worst, and that always plays out because it's just human emotion doing its thing. And the bigger the event, the more illogical it seems, and that certainly applied to last week. Today's news was priced in weeks or months ago, so just get used to it, don't fight it. Price action always should be believed, and that point will be very, very obvious when we look at the charts of the American indices last week. Quite extraordinary. And contrarian awareness is vital. Now, you don't just buy to be a contrarian, but you certainly need to be aware that when prices are moving rapidly in one direction or the other, be it up or down, that there is an opportunity building if it's a quality stock. If it's a rubbish stock, then it will probably just keep going down and down. But if it's a quality stock that's being oversold, which often happens in panic, then there will be a point where a reversal will occur and the market will show us. We don't need to guess it. We don't need to know it by some divine intervention. We just watch the charts and respond. So sentiment extremes are a really valuable tool for traders and investors. Next, shut out the noise and simply observe and respond. If you're trying to follow the news and make sense of the market price action as a consequence, you'll just drive yourself to absolute distraction. So you've got to completely ignore that. And everything is around risk management. Assume that nothing is going to play out as it should, and you just focus on managing risk. And if you do that, then you'll do better than 99% of other people in the market who don't know how to do it. Let's look at the Middle East war. A question that I haven't really seen answered anywhere, maybe even not even asked anywhere, is if Iran agrees to a deal, what is America prepared to give them? And frankly, I can't see that either side has got anything that the other side wants that's important to them. So I just cannot see an overlap in any respect. There is no viable basis at the moment for a lasting deal. Now, having said that, that's the logic of it. And as we know, logic often doesn't guide the price action. Are the straits open or are they closed? I think the answer to that question depends on which hour you check the news, because in the last 48 hours, that position has changed at least 5 times that I'm aware of, or has been reported to have changed multiple times. And it really depends a bit on who's saying it. So I don't see that we're any closer to resolution than we were a week ago, and yet the US market has done some stunning things. Now, if you look at the source of US power around economics or just the logistical reality of being able to manufacture enough weapons to continue this fight at the current rate, and also the economics of the US being able to afford to continue it at this rate, that has to play some part in how the war progresses. So that's yet another massive uncertainty. And if you look at the economics, we know that there is a trend towards de-dollarization has been going on for a number of years now, and there are less countries that are prepared to buy US debt as they did in the past. So who's going to fund it? And obviously, the US Fed is going to be one of those funders, and that's just going to create more and more inflation and can only be good in the long term for gold. So we haven't really moved anywhere. The market has moved significantly, but the fundamentals haven't moved anywhere. We've just got this huge basket of unknowns in so many different respects. So that's where we sit with the US. And I thought it was interesting just to look at, I have a quick look at the market. So this is the NASDAQ for the last 3 weeks. As you can see, the low in the NASDAQ was the 30th of March. And since then, it's just gone up in a straight line, and we've now set new all-time highs. But this is the real stunner for me. And if I may be allowed a John McEnroe moment, you cannot be serious. When you look at that chart, that was the first thought that went through my mind on Saturday morning when I saw this chart. You cannot be serious. That is the market's response to that huge basket of unknowns. So that was my first response. But I've been in the market for decades, and I was able to quickly regather my thoughts and remember that it's all about the price action. And so if you just manage risk and you just respect the price action and don't kick and scream and fight against it, then you'll be much better off. So we'll come back to those charts. And this was the other slide that I showed last week, which again, I think is really important. I've been doing these videos for a long, long time with the purpose of providing a perspective that most investors don't get. And that's a helpful perspective in how you think about the market and how you engage the market as an investor. So the questions that I posed were, first of all, what is it that you want as an investor? What sort of return do you want? And I understand a lot of people don't really know what's possible, what's a good return, all those sort of things, but you've got to have a stab at it. You've got to have a sense of what sort of return you want from the market. And also, and most importantly, what is your tolerance to volatility? Because that's the thing that trips most investors and traders up. It's not where the price goes from this year to 3 years' time. It's what the price does every day, every week along that journey. Because if you don't have confidence in your process, you question everything. So what is your tolerance to volatility? And I just ask, who made the effort to do this? It is such a simple thing, a couple of questions that should only take you 10 or 20 seconds to think about. But in my experience, in mentoring a great number of people over the years, for whatever reason, this is something that nobody ever seems to want to get down to tin tacks and actually do and reflect on. And practically, what does that mean? And what I've been saying in recent weeks since the war started is that there are some targets. There's only a relatively small number compared to the whole market, but there's still more than enough, multiples of enough targets that are immune either from the energy shock coming from the Middle East and or the impacts of AI disruption on certain business models. There are some stocks that are immune, and the price action demonstrates that they're immune. Now, if you don't know how to do that, and I understand that that would be more difficult for most people because unless you're immersed in the market, you really don't know what the targets are, but it's easy enough to get access to those. So really important, given we've got this massive basket of unknowns, both in type and also in time, to define a bunch of targets that are suitable for you, that are immune from those external events. Because otherwise, how can we possibly manage risk? We're going to be constantly buffeted from one side to the other. So the fundamental analysis gets us to the right fishing hole, an analogy I've used before. Once we get to that fishing hole, we then find the best of the best in each category. Again, for someone who's immersed in the market, it's a very straightforward, relatively simple thing to do. And then risk and portfolio management is driven by the money flows and the chart patterns. So you let the market be your guide. You don't need to guess. And then shut out the noise. So again, I just posed the question, who took the time to spend 20 seconds thinking about this last week? Because I can tell you that those that did have immediately put themselves to the top of the investing queue in terms of long-term returns. Because it shows that you're prepared to do the few simple things to get yourself on the right track. And then you just add a dollop of patience and discipline, and it all comes together pretty nicely. But it's just about clarity. And of course, we advise that you get all the other required advice that you need, be it financial, legal, or any other advice before you embark in this market, which is both a tough one if you don't know what you're doing, but a terrific one for opportunities because of the volatility and sometimes the completely irrational volatility. If someone wants to sell me their great stock at half the normal price, then I'm afraid I've just got to buy it from them. And that's the way that you need to think about the market. Let's look at American stocks now. The S&P added 4.5% for the week and the NASDAQ 6.8%. I mean, it's just, you scratch your head and you think, how is that possible given the background that we've got? What is Wall Street thinking? But it doesn't really matter because it just is. There is a wall of money that is propelling quite a lot of stocks to the upside. Let's forget about the indices. Let's just zero in on stocks that have got what it takes to continue to go a lot higher, that have been through a significant dip and have now turned around, and the market is showing us that the buyers are now coming back in. So IWM also added 5.5%, so that's the Russell 2000, so very broadly based rally. And I did note several weeks ago that the pros were buying, if you looked at intraday charts, so many stocks gapped down on the open, and then that was somewhere near the low point of the session. The pros stepped in and just kept buying that intraday panic. And it's such a reliable signal when you get to markets like this, markets of extreme, like we saw around COVID, like we saw with the Trump tariffs in 25. It's just a very, very reliable signal, but it's one that you've got to take the time to nut it out. You've got to be able to watch the market action on an intraday basis. The US dollar index was down a little, 98.23. The yield slipped back a little. And the VIX index, which was, I think, 2 weeks ago, or 3 at the most, was above 30. We're now down to 17. So let's take a look at the rest of the US charts. So that's the NASDAQ on a weekly chart. And look, it really is a head scratcher, but I don't pay too much attention to it. I look at the workbook that I've got with 150 charts that have been in uptrend for 12 months, 2 years, 3 years. That's my working chart. I know exactly what I'm looking for, and I just wait until those stocks pull back to a position. And I've got 10 times as many as I would need to buy. So I don't really care which one it is. I don't have to own any particular stock. I just take what comes. This is a ratio chart we've been looking at for some time now, consumer discretionary versus consumer staples. We came right off the boil, and it looked very similar to the start of 2022 when the big tech stocks went down the whole year and went down significantly. But we've now turned around very, very abruptly in the last couple of weeks, and the money now is flooding back into consumer discretionary in preference to consumer staples. So the market has become much more aggressive in attitude. And if we look at the semiconductor index on a weekly chart, just looks superb. 2 very, very strong weeks. Let's look at the relative comparison chart. In America, obviously energy has come off significantly in the last couple of weeks. So this is over the last quarter, the last 3 months, starting from a common point. And energy peaked up here on the 27th of March. And since then, it's progressively come off. A lot of that has become washed out. And the money has been flowing into XLB, obviously, so materials in the States. And you can see XLK, which was right down the bottom here just a week or so ago, has absolutely rocketed up. So a lot of money flooding back into technology. And that was always going to happen because the sentiment and the price action towards so much of technology was just really, really powerful. So there were parts of that market that deserved to be sold off on a risk management basis, being software being the main one. But there were other parts where there are terrific companies that haven't missed a beat, but they also got sold off very temporarily, but they're coming roaring back now. If we look at the Australian market, the response in energy, it didn't go up to the same degree and it hasn't come down to the same degree yet. However, the oil price since Friday, since our market closed on Friday, has been diving all over the place with the news out of the Middle East. So I really have no idea what we're going to get on Monday. Finance, the banks started coming off a bit last week, which is why the finance index lagged. Materials have also done relatively well, and the ASX 200 is sitting there right in the middle. Also, healthcare has been down for a fair while and isn't showing any positive signs yet, but certainly information technology had a very strong finish to the week. The S&P index looks very similar to the NASDAQ, just a little bit less in amplitude, and the Russell also on a weekly looks very similar. So all indices in the US breaking out. That's an incredible sign and very unexpected sign. Aussie Stocks, our dollar was at 71 and our index was down 0.2% for the week. And given the correlation between the Australian index and the American index last week, normally I would have said with the US having such a powerful finish to the week that we would open quite brightly, and we may well do. But the problem's going to become, can it be sustained? Because our market just seems to go very weak at the knees after about 30 minutes. And there is a fair amount of selling going on. And I guess that is reflective of the fact that our economy has huge question marks over so many parts of it that are structural. And that's the worry. These aren't transient issues that can be fixed quickly. These are structural issues that are going to take a decade to fix. But if we keep being complacent about it, they'll never get fixed and our standard of living will just continue to go down. So stocks are reflecting that reality that's starting to really become clear in the market. So I don't see that our stocks are out of the woods yet, even if there was a ceasefire to hold, which is hugely problematic. So I think the pursuing of so-called immune stocks is even more important, far more important in Australia than it is in America. There's a lot more degrees of freedom in America because those stocks are not as at risk as much of our market is. So in our market, accumulate on pessimism, find the immune stocks, wait for the confirmed shifts in money flows from sellers being in control back to buyers being in control, and just do that. So really narrow your focus. As I said, energy and finance were down. Materials and infotech were the strong rebounders. So just for the record, let's have a quick look at the indices for the Australian market. So there's the ASX 200 on a daily chart. And if we put it on a weekly, you can see there was absolutely nothing happening in our market last week. Just a quick look at the currencies. DXY, you can see it was a bit of a roller coaster. We did get down to 97.5, but the US dollar did rally. And the Australian dollar actually had a more positive week. Let's move now to the precious metals, gold and silver. So this is silver on a daily chart, and you can see we're now back into uptrend. But overall, since the market first for precious metals first cracked at the end of January, we've really just got one massive volatile sideways move. But certainly in the shorter term, this is looking positive. I'm extremely bullish in the long term. I just don't know when the really bullish phase will kick back in. It'll almost certainly happen when we're not expecting it. That's just the way that markets work. So if I was you, I'd be keeping your ears alert to negative sentiment towards precious metals. And that probably won't be too far away from a really good long-term entry point. Here's the gold chart. And it's looking more positive on most timeframes. So that's still in big picture uptrend because the 200-day moving average is still moving up at an uninterrupted angle. So that's the long term. So you can analyse the last 3 months to whatever depth you want. But the fact is that the long term, which is really what we should be interested in with a commodity like gold, is clearly up, and it's uninterrupted, and the price is well above that moving average. So we just sit back and let it do what it's going to do, knowing that the fundamentals are certainly a pretty strong tailwind. And there's the Australian dollar gold price. Again, very little change. So for the last 3 weeks, any moves in the gold price have really been soaked up by moves in our currency. So just to summarise on precious metals, gold up 1.7% for the week to 48.33 or 67.44 in our money. Silver was up 6.3. So again, it outperforms in both directions and closed above 80 again. Gold stocks, the ASX for GDX. So these are overseas gold stocks primarily. There are some Aussie gold stocks in there, but primarily overseas stocks. But this is the listed version on the Australian market, was down 2%. I think events of the last week or two with respect to the availability and price of diesel means that local risk is a little less likely at this stage. Risk in terms of shutdown or impact on operating costs, but it is far from over. It's still present. So that's the important thing there. And Australian gold producers still have an uncomfortable degree of risk from my perspective, not because I think it's going to happen, but because it could happen. And in this market, there's so many bad things could happen. I just want to move to positions of largely immunity. Turning now to other commodities, copper really shot up very, very strongly, $6.08. Crude oil has been all over the shop between 85 and 110 over the last couple of weeks. The ceasefire, whatever you want to call it, I don't know whether we've got one or not. I don't know whether the straits are open or not. There's no point thinking about it because it just changes so often. Even if the war ends tomorrow, it does not fix the crude or liquid fuels mess, and particularly with LNG. So this is going to take a long time to get back to normal, and we haven't even reached a stable environment. And if you look at the Ukraine, where we've got two sides that are incredibly intransigent, then who knows how long this Middle East situation will drag on for. So higher prices are here to stay for some time when it comes to crude oil. But those higher prices could be anywhere between where we are now and pick a number, $150, $200. No one has any real way of knowing. There's the spot copper chart, really shot up very, very strongly last week. And there's the crude oil chart going in the opposite direction. So Wall Street is betting that the war is close to finishing. They're believing Trump's rhetoric. I'd rather just make my decisions on a different basis altogether. So the final message from this week, we just cannot trust any of the news out of the Middle East because it's either fake news or it could change in the next hour. So we cannot trust anything with respect to Middle East resolution. The players involved are just far too unpredictable. So don't even try to go there. Position yourself based on a comfortable level of risk for you. And if you don't know how to figure that out, then you really do need some assistance very, very quickly. Because if you don't know that basic thing, what is a comfortable level of risk for you, then you're going to make some very unfortunate decisions when things get really volatile. But I guess the strongest message is don't shy away from opportunities. If you've got a great stock and it's gone through a dip, so we've got some of the profit-taking overhang out of the way, and the market is showing you that the money's flowing back into it, then go for it. Don't be put off by the big picture and put off by the headlines, because the market is showing you that it's well and truly prepared to support those sort of companies. But the best thing you can do is to focus on stocks that really are truly immune from the large external factors, be they energy or AI disruption, which are the two main ones at the moment. So just seek out the best stocks that are in truly sustainable megatrends. And there are some out there that really just are not affected by what's happening in the Middle East. And then it's just a matter of buying the dip that you can live with. So the stock has gone through a dip. It may not be the bottom, so you are taking some degree of risk. But as long as you can live with that degree of risk, then go ahead and do it. So that's the final message for this week. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.